Joining me now with more is Art Hogan. He's a chief market strategist at B. Riley Wealth Management. Art, always great to see you joining us from California this morning, so we appreciate the early wake up. And as we get ready to open these markets, what is top of mind for you?
Well, you know what I think is interesting? For the past several weeks, call it the last 6 weeks, everything that the investor focused on was about trade. How big would these tariffs be? How is this 90-day negotiation period going? When will we get deal announcements? And with a couple of better pieces of news there, investors have certainly shifted away from that focus and shifted their focus on the budget. And the budget really is, in the thick of it right now in the House. If they can get that out of committee and voted on over the weekend, it goes over to the Senate. But you've got a couple of factions, a couple of caucuses, the SALT caucus and the fiscally conservative caucus, that want to hold this up a bit. The president was on Capitol Hill yesterday trying to get some sponsorship for this. But this is really important, Kristen, and I think you framed it correctly. There's four pillars of the new administration's policy, and two have been implemented. One is trade and one is tariffs. But clearly keeping the 2017 Jobs Cut and Tax Cut and Jobs Act in place is going to be an offset to some of those negatives, and certainly a lighter regulatory touch would also help. So, we desperately need to have that, and that's why investors are watching this very closely, and that's why the market seems to be tracking Treasury yields as they've drifted up a bit, with the 30-year above 5% and the 10-year above 4.5%.
And walk us through that correlation, or what these higher yields potentially mean for stocks.
Well, a couple of things. So first and foremost, it is the bond market telling us that we're not doing a good job with our budget writ large, right? So even with passing of this big, beautiful bill, there's certainly going to be an increase in the deficit, and we're going to have to take up the debt limit again, and that's why there are caucuses and groups in both the House and the Senate that are pushing back on some of these things. So to the extent that the bond market is saying, pay attention to what Moody's said and the other rating agencies have said over the years, you need to run a tighter budget here, and that's not in this proposed bill. At the end of the day, we go through this process multiple times over the course of the last 2 decades. We'd likely get this passed. It likely passes at the 11th hour, but I think the bond market is reminding investors that you don't want to get too close to the edge on any of these things.
Is there a realistic timeline that you anticipate that this budget bill will be passed?
Yeah, probably past July 4th, but before Labor Day, and I think that that would coincide with some of the things like the end of this negotiating period, which is July 8th, the end of the negotiating period with China, which is the second week in July. So to the extent that you're going to be running out of some runway on the trade negotiation process, you'll likely have momentum enough to get this out of the House, over to the Senate, and something that the president can sign. It probably doesn't look exactly the way it's coming out of conference in the House right now, but it's going to look similar, and that'll just mean, at the end of the day, one of the things that this president ran on, which was a continuation of the Tax Cut and Jobs Act from 2017, will be firmly in place. But there's going to be a lot of things around the edges that'll be different.
Art, what are you going to be watching from the retailers that are reporting this week here at the tail end of the first quarter earnings season, that is? Of course, the results are backward looking, but it does seem like any comment on tariffs and outlook is top of mind for traders.
Yeah, it's had a little bit of a dichotomy between Walmart, which reported last week, and then Home Depot came in their commentary around taking price because of the tariff and import prices. Certainly, were an interesting juxtaposition. And I think one of the things Home Depot didn't talk about is the fact that there's a carve out for lumber prices, which is a big part of their business. But they're, both of those major retailers are going to use the platform approach, meaning not necessarily taking price because of tariffs on individual items, but looking at the entire row and saying, all right, where can we incrementally increase prices? I think the real wild card, is going to be TJX, because they actually are beneficiary of a lot of what's going on with import prices. They don't pay import prices in tariffs because they're actually buying directly from retailers that have too much inventory. So they're actually going to probably end up being one of the winners in this process, meaning if you've over-inventoried, in the first quarter, if you bought too much in your department store, it's going into the discount chain, and TJX is one of the best in business.
Yeah. Any concern about the path forward for growth, Art? Of course, there's a range of outcomes that I think some are preparing for. Where do you land?
Well, I'll tell you this. We pulled forward a lot of demand in the first quarter, and that shows up in the import and export numbers. It certainly shows up in retail sales. So whether you're an enterprise or you're a consumer, you certainly have pulled forward demand trying to front run tariff pricing. So that is going to be something that shows up as a slowdown in demand in the second and third quarter of this year. I think that's consensus. So we'll probably see GDP growth rates as it pertains to goods demand see a bit of a drawdown in the second and third quarter. That's natural. So the function is how quickly we assimilate these new higher prices and what demand looks like, and that's going to be dependent on how strong the labor market is. Right now, we haven't seen any cracks in the labor market, but if that second and third quarter slowdown in demand actually turns into higher unemployment, then that's where you get into this could turn into more of a slowdown than not. That's not our base case. We expect the second and third quarter to be slower and see a pickup in demand in the fourth quarter.
Interesting. And with that base case, Art, how do you think the Fed responds?
Well, I would say that every time they get a 90-day timeout on this trade process, they take a 90-day timeout on their making a decision on monetary policy, which makes a great deal of sense because they can collect more data and see what the actual impact of these new tariffs are going to be on both employment and inflation. And if in fact we land at a place where consensus is now where there's basically a 10% universal tariff and something around 30% for China, then the impact of the new tariffs spread out across everything that's imported is about 12.5%. They will look at that likely as a one-time price increase and then start focusing on the growth side of their job, which is basically, is unemployment going up and should we start to cut? So we probably don't see any action from the Fed until September, but then we'll probably see them cut a couple of times because of that slowdown we're going to start to see in the second and third quarter.
Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, always great to see you. Thanks so much for joining.
Thank you.